All right. Good morning, everybody, and thank you for joining us for today's webinar. Ryan Bouchard, our investment analyst, and I will be sharing some thoughts about the year that was 2020, and we'll also be talking about the outlook for 2021. And by way of introduction, I just say, first of all, a very heartfelt thank you to Marissa in our office who really helped Ryan and I make this presentation much better than it otherwise would have been. She's always a great partner to us when we're working on things like that. So thank you to Marissa. And thank you to each of you for taking the time today. We hope that you'll enjoy the content that we share. I'd start maybe with a 30,000 foot view and just say, 2020, I was talking about this earlier and I referred to 2020 as a pretty good year. And I said, well, that's it's probably not the exact language that I want to use. So what I would say is, 2020 was a more productive year for investors than many people would have guessed in the midst of COVID-19 back in March, April, May even. So, we're really, really happy that investment returns ended up where they did for 2020. And really, as we think about 2021, there are a lot of reasons to be optimistic, and we're going to spend some time today going through those. We're going to talk about market performance for 2020 and put that in a context and share a couple of things that are a table set for what we're looking for as we head into 2021. And then we'll also talk about the environment that we're in. We'll talk about that from, the stimulus that we see coming down the pipe. We'll talk about that from a political environment, an election outcome perspective, and we'll also talk about it from a broad economic perspective. And as we go through some of that data, I think you'll see why many of the forecasters are actually looking for another productive year for investors in 2021. Clearly, one of the key things driving all of this is the COVID-19 virus, the vaccination to address it, and then the recovery of the economy as a byproduct of that. What we would share with you is that, at this point, vaccine distribution is running at about 30 million, although the actual administered vaccines is around 12 million in the United States. One of the resources that we've been relying on is the Bloomberg Vaccine Tracker, and we'd recommend that if you're curious about such things, it's a good resource that you can check out and see just how rapidly individual states are administering the vaccines they've been given, or how many vaccines they've received. Those are two important components. Again, right now there are two vaccines that are approved that are being distributed. Both the Pfizer and the Moderna vaccines are currently in distribution phase, but there are others that are in development, and we do anticipate that we'll see more vaccines coming online. Specifically, the Johnson & Johnson vaccine had some positive news out yesterday, I believe it was, and the expectation is that maybe they're looking for emergency use approval from the FDA in February. That would, again, just improve the pipeline and get more vaccines out into the public, which again allows the economy to reopen more fully. So that's going to be a big part of the story as we move forward, but there's a lot of optimism there. Ryan shared an interesting analogy with me. He is, kudos to Ryan. He has listened to more economic thought and market outlooks in the past 2 weeks. I kept sending things, hey, I can't make it to this one. Can you? He's like, yep, I'm already signed up for it. So he's heard a lot. And the thing that is a bit encouraging is the very consistent view that, when these vaccines roll out, whether they're, we're behind where we thought we would be at this point. There was an expectation we might see 20 to 25 million vaccinations given in December. We didn't hit that. But Ryan used the analogy of a train pulling away from the station. And so that's a good way to think about this vaccination protocol. If you've got a locomotive, it takes a lot to get that thing moving. But you begin to build momentum, it begins to accelerate, and that is what the market is expecting for these vaccine rollouts and the subsequent reopening of the economy really into the second and third quarters. So with that, I'm going to go ahead and turn it over to Ryan and let him share some data that we have for 2020 and kind of use that as our table set to talk about 2021.
All right, thanks, Phil, and thanks again to everybody for joining us. Phil, I'm assuming we've got the right slide up here. You can see that from the webinar's perspective. Okay. So yeah, we'll kind of talk through how the year shook out. This is full year 2020. What you're looking at here, you've got the red bars all the way along the left-hand side. Those are U.S. stocks broken up into the S&P 500. So large cap, U.S. large cap core, and then you've got large growth, large value, mid cap, small cap. The purple bars in the middle are international stocks. So international large cap, small cap, and then also emerging market. The green and the orange represent kind of alternatives. So the green is global real estate, orange lines being your other alternatives. And then all of the blue bars along the right-hand side are bonds. I just kind of wanted to set the table here because the next 5 or so slides, we're going to talk about how the overall year shook out. And then we're going to kind of divide it up into 3 kind of distinct time periods. There was kind of pre-pandemic, and then the subsequent drop, and then the recovery. And really the recovery had its own kind of 2 phases. The first 6 months of recovery looked a certain way, and the last 3 months of the year looked a little bit different. We had some rotation. So we'll take a look at those. So this next slide here, this is the drop. This is from kind of mid-February to towards the end of March. Fastest drop, fastest correction, fastest bear market in history. And because it only took a month, we've never seen a bear market develop in a month or less. Here you can see the S&P 500 down about 34%. Small caps had it worse, down 41. International stocks were not immune. This was a global pandemic, so it affected everybody. Even bonds were down. The only real safe haven was kind of the shortest term treasury bonds. Kind of middle and long-term treasury bonds also did well, but that was really because interest rates got slammed to the floor with the Federal Reserve coming in with a lot of monetary stimulus, trying to make sure that we had enough liquidity in our system to weather what we didn't know. We didn't realize how long this would last, and so they came in over the top to try to help us out. The subsequent recovery. Now this shows through the end of the year. This is from March 23rd and through the end of the year. You can see an enormous bounce back. Pretty good performance across all segments. Everything was up. When you're looking at a kind of a segment or an asset class category from an overall perspective, everything bounced back pretty well. But this is the time period that I kind of wanted to deconstruct here. This recovery through the end of the year. This was kind of the first 6 months of that recovery. You can see you had a continuation of trends that were already kind of in place. Large cap growth was outperforming. A lot of those are tech stocks. You also get some consumer discretionary like Amazon, online retailers like Amazon. You did see small and mid cap stocks bounce back, but still, kind of in line or a little bit underperforming large stocks. Now, a lot of the reason for this was because while the economy was doing poorly, a lot of small businesses were seeing difficulty reopening their doors and complying with all the new regulations, all the new safety regulations. A lot of the largest companies in the world, which are the ones that are represented by the stock market, you think of Walmart and Target, Costco, those were all back online, ready to serve customers. And they had new protocols that they switched over to quickly. And so you saw a real shift in market share from a lot of these small businesses to a lot of the larger, well-capitalized companies in America. So that's why the market did so well, despite the fact that the economy, from a jobs number and from a GDP perspective, was still kind of, having a tough time with it. So this is what it looked like through the end of the third quarter. Now, if we look at the last quarter, what I want to kind of illustrate here is that you saw a real outperformance by small cap stocks. You saw a real rotation. A lot of this was kind of it's a cyclical rotation. Once we've kind of put a foundation in and we've got some visibility for how the economy should rebound and how it should look going forward, now that we've got some vaccine distribution underway, we see that a lot of these small cap stocks and also value stocks, if you look at the value stock column there, it outperformed growth. And that was because you see a lot of capital intensive companies like Caterpillar who maybe had negative earnings in the the first quarter of the year and the second quarter of the year. those companies will go from negative earnings to considerably positive next year once sales resume and once the economy starts to kind of turn around. So you saw a real rotation out of kind of asset-light companies like online retailers and into more cyclical and value names. It's where a lot of the small cap outperformance came from as well in the end of the year. I would also point out, on the international front, emerging markets performing very well. A lot of those are they're leveraged to a global economic recovery. So when you get a bounce back in the global economy, a lot of those countries, emerging markets, are going to perform very well as they supply a lot of raw materials to this boom, this recovery. So with that was kind of how the year unfolded.
There's one thing that I'd add to that. You noticed on some of these slides that during the sell-off, a lot of these different asset classes had pretty significant losses, and then it would appear that they had even larger gains in the recovery, and that's the mathematics of losses and gains. And so there's an important takeaway here, so I want to spend just a minute on this topic. If you had $100,000 invested and you lost half of it, you lose 50%, you're left with $50,000. And then for that $50,000 to get back to where it was, you don't need a 50% return. You need a 100% return for that $50,000 to get back to $100,000. So I wanted to put the returns that you just saw in an appropriate context, but there's a really important point to that, and that is, if you have the discipline of rebalancing during the period of weakness, you get more dollars into those weak asset classes. So when they have those 70, 80, 85% recoveries that Ryan's showing you on this page, you have more dollars there. And then for many of our clients, we ended up having to turn around and do the opposite. We rebalanced during the period of weakness, and then once things bounced back, we had to sell some of those equities to buy the bonds. And so that's actually really, really productive, and it's the additive behavior that you can engage in during periods of high market volatility. Now, as Ryan said, this was one of the fastest, it was the fastest bear market that we've ever seen, and the fastest recovery from it. And so being nimble and taking the action that you should during those periods really does help the overall portfolio have a better return at the end of the experience.
Yeah, great points. Yeah. So even though the market did end up, here was the full year 2020. You see kind of most of the asset classes higher, pretty well higher for a lot of the stocks, especially in the U.S. It didn't appear that way if you look beneath the surface at some of the industries and sectors that were involved. Not everything is fully recovered, so kind of wanted to talk about that. Here on this slide, we've got the returns for different sectors and industries arrayed from highest returns to lowest returns. A lot of sectors aren't mentioned here in this slide, but online retail, obviously the biggest beneficiary of everybody stay at home. You still need groceries, so we'll figure out a way to get you everything you need. Clearly the biggest beneficiary. Another one that stands out, technology, obviously that was the solution to a lot of this problem. This call being conducted on Zoom is a perfect example of that. Home improvement is one that is ironic. It jumps off the page. But yeah, when you spend all 24 hours of the day at home, when you never leave your home, you start to notice every little thing that's wrong, every little doorknob that you want fixed, and every paint color on the wall that you want a different color. And so Home Depot and Lowe's have done very well in this period. You look all the way to the right-hand side of the page, obviously energy, with transportation down, not a lot of people flying to different destinations, a lot of vacations canceled, just not as much energy consumption around the world. Airlines, retail, real estate. You've got cruise lines, obviously those have been sitting with nobody in the ships, nobody moving. So it's you know, it's kind of bifurcated. You've got some industries that have recovered well, others that have not. And this is another example of what we may start seeing, this kind of cyclical rotation as the global economy recovers, once vaccinations are administered, and once people get back out there and start spending money again. So, Phil, I know you were going to give us some perspective on some stimulus.
Definitely. And it's interesting, even just looking at these industries, there is a pretty high correlation between the industries that struggled that may be doing better as we go into a period of recovery. A lot of those are in that kind of value element that, you know, Ryan talked about. Small companies did better in the fourth quarter. We started to see a little bit of a rotation from growth to value. We've seen the biggest of the big companies and the most growth oriented really do very, very well, not just in 2020, but for the last couple of years, really markedly better than their peer group in 2020 though. And some of that might be changing, you know, if we see a little bit more of a differentiation between short and intermediate term interest rates. Financial companies could do better, with the banking industry doing a little bit better with that spread. Certainly if we do get these vaccines in place, I know I've spoken to at least a couple of our clients who would like to take some trips that they didn't get to take in 2020. So I think there's some demand for airlines and for hotels, resorts, and cruise lines going forward. But yeah, Ryan, you're absolutely right. You know, talking about stimulus is definitely an important part of our conversation today. And here's a collection of data that just helps put into perspective how massive the stimulus has been. And the stimulus comes in a number of different formats. What we've done here is we're looking at the two primary forms of stimulus, that being monetary stimulus plotted across the chart from left to right. And that is, what is the central bank doing? In our case, the Fed, but in central banks around the world in this slide, with more monetary stimulus being further to the right. As you go from the bottom of the slide to the top of the slide, we're looking at fiscal stimulus, which is how much help are the governments themselves doing via their spending. And you know, the thing that we would point out is all these blue dots, which are the global responses to this virus, are extraordinary. We've never seen this much stimulus, certainly in terms of monetary stimulus, but also it's never been higher for fiscal stimulus, but for the U.S. response to World War II. Again, you can see that dot in the top left corner where there is a massive amount of spending, but the central bank really wasn't doing a whole lot to help the recovery. You see the Great Depression, as severe as it was, still more modest than the U.S. response to this global virus crisis. So a lot of help is being given to the economy, and that's one of the leading reasons that folks are optimistic about the U.S. economy recovery and markets. And we'll show you some data as it relates to the value of stocks and the earnings that we expect going forward that really comes alongside from that standpoint. The next slide looks at kind of an add it all up view of the monetary policies. And it's just, when you look at all of the central bank stimulus that has taken place globally, it really kind of takes your breath away. You know, it isn't just the United States, and you know, this is a global pandemic, as Ryan said, and therefore, you know, you go all the way back through the financial crisis of 2007, 2008. The response then, which was massive, pales in comparison from a global perspective. And so we're really looking at this and saying, all right, there's a lot of fuel, and there are reasons to be a little bit cautious about what does that all really add up to? How is that managed on a going forward basis? We'll talk a little bit about inflation later this morning. And this is one of the things that really feeds some higher inflationary concerns. However, higher inflation, specifically runaway inflation, is not expected by most folks at this point in time for a variety of reasons we'll talk about in a moment. So with that, let's talk a little bit about the election outcome and let's talk about the leadership that we see in our country at this point in time. This is just a really interesting piece of data that we saw. I think this one came from an Outlook presentation Ryan got to listen to from JP Morgan. But what they did is they looked at the amount of how big was the majority in different seasons. And so you can see points where there were very dominant majorities either by the Democrat or the Republican Party. And that's not the reality we're looking at today. We're looking at the narrowest of advantages. The Democrats do hold a majority in the House and the Senate. Actually, it's a tie in the Senate, but Vice President breaks the tie, so it'll be a 51-50, including the Vice President. And of course, next week, Joe Biden will be inaugurated as our next president. So the Democrats will have the White House, the House, and the Senate, but the margin of their advantage is extremely slim, and that is important because the ability to implement policy is perhaps going to be a little bit constrained given the narrow majority that the Democrat Party has. And so, where there was a lot of conversation about a blue wave coming through in 2020, that is not really what came to fruition. As we look at the next slide, there's an interesting conclusion to be taken from this, though. If you dig down a little bit deeper, and you look at the Senate in particular, which, most people think, prior to the two Georgia Senate seat runoffs here earlier this month, we knew that Democrats had a majority in the House. And the question was, well, will the Senate be kind of a firewall from that legislation making it to the president's desk? And now the Democrats do have that narrow majority in the Senate, so it doesn't appear that the Republican Party can be that kind of firewall. But if you look at the complexion of the individual members of the Senate, there are a lot more Democrat senators who are closer to the moderate frame of thought than there are Republicans. And the point would be, with a 51-50 majority, you need everybody to be on board, or you need some of the Republicans to flip over and vote for legislation. And this picture really says, good luck finding very many Republicans who you might be able to get to vote for some of these policies. They're more conservative, and there are really only two or three that might, on a given issue, support a piece of legislation advanced by the Democrat Party. But more to the point, look at the blue dots and just be aware that there are 3, 4, or 5 of them who are a little bit more conservative in their thoughts, a little bit more moderate. And if you need to get everybody lined up behind a piece of legislation, it could literally only take one senator to prevent a piece of legislation from passing, assuming that the Republican constituent or the Republican caucus stays together. And so this is a really interesting dynamic that we're going to see over these next 2 years until the next midterm election. And it'll be interesting to see. The very first proof point of this might well be President Biden's request for a $1.9 trillion stimulus package. That just hit the news. We've been watching the responses to that, and some of the folks that follow that pretty closely are saying, we don't think there's a high likelihood that 1.9 trillion is what actually gets approved. We think it's more likely that might be closer to 1.1 trillion, which is still a massive stimulus. I don't want to take away from it. I mean, we are talking about trillions of dollars here, but just that singular issue is maybe what we should expect on a going forward basis. That while President Biden might desire to pass a certain piece of legislation framed a particular way, the negotiations even within the Democrat Party itself might cause a little bit more of a moderate version of that legislation to take place. And that will play itself out as it relates to tax rates, as it relates to, spending packages. There are a lot of places where that may cause the results to be a little bit different.
Yeah, I think compromise will probably be the name of the game.
Well said. Well said. So with that as kind of being the backdrop that we're operating in, what does that mean for the U.S. economy? And so as we move forward, we always like, looking at data from various sources. This particular data comes from Fidelity Investments. And one of the things that they do on a regular quarterly basis is they evaluate where in the business cycle the major global economies are. And what you can see is, we've come out of a recession, a period of contraction, and we're now in the early stages of a recovery that will lead to expansion. And that's a good place to be. It gives us a lot of reasons for optimism. And I'll draw your attention to the top part of this chart that describes what actually happens in the early phases of a recovery. And in that phase of the business cycle, you're going to see GDP activity increase. You'll see unemployment rates coming down. You'll see incomes growing. Access to credit will grow. And right now, we all know interest rates are so low, acquiring debt has been very, very attractive, both for companies and for individuals. And we're going to talk a little bit more about that. I'll kind of steal a little bit of Ryan's thunder here. The consumer balance sheet looks fantastic. The corporate balance sheets look really, really good right now, which puts them in a position in this phase of the economic cycle to see profits growing pretty quickly above trend. The policies that we see are still very, very stimulative, both from a monetary policy and from a fiscal policy perspective. And in fact, we've seen people refer to the Georgia Senate election outcome as creating kind of this Goldilocks fiscal scenario where the Democrats do have the majority that's necessary to maybe have to have a larger stimulus than might have otherwise been the case if the House and the Senate were divided. But it's not such a dominant majority that we'll see a lot of action taken that could slow growth. So we really could have a very stimulative environment here going forward. And again, right now, and we keep hearing stories of inventory challenges. And, coming out of COVID-19, when the whole global economy had to react to that and cross-border imports were impacted by that. The supply chain is still recovering from some of these shutdowns earlier in 2020. And so we see an inventory restocking that will occur and improve sales on a going forward basis. I had to stop by a store yesterday, and it's a store that I hadn't been in for probably 9 months or pre-COVID. And I walked in and my jaw almost hit the floor because the inventory I saw was a fraction of what I saw last time I was there. And it wasn't just that the racks were more thinly filled. They had fewer racks. They literally probably had half as many racks, and those racks had probably 2/3 as many items on them. It was absolutely unbelievable, and it was a stark contrast. And I'm not sure how quickly that's going to come back, but there is going to be a restocking that occurs, and that could be positive for the economy. So very optimistic about where we are, having come out of a recession and now being in the recovery phase. That's a good place to be and could mean good things, not just for 2021, but perhaps for the next few years. So Ryan, why don't you expand on that a little bit and help everybody understand what that impact could mean for GDP here in the U.S.?
Yeah, so we'll dive down into a few different numbers. GDP, obviously the granddaddy of them all, it kind of tries to wrap up and encompass kind of an overall measure of how the economy is doing. So let's take a look at that. Here's where we are. This last data point here in blue, the blue is the actual line. This dotted gray line up here is where we would have been had we continued about 2.5% trend growth over the next several quarters. And then this green line here assumes, what if we just get consensus expectations for GDP growth over the next 6 quarters? Where would we be? And really kind of the point of this is that, the last data point that we have is from the 3rd quarter of 2020. In a couple weeks, we'll get the 4th quarter number. People are kind of expecting around a 5% number for that reading. When you look at—
It's a great reading, right? I mean, the GDP to grow 5% a quarter is outstanding.
Yeah, absolutely. But so we were down about 30, I think it was 34%, and then we were back up 33%. And as Phil described earlier, is that when you fall from a number, it takes more than that number just to get you back to even. And this chart really kind of illustrates that. Right now, as of the third quarter number, we are about 3.5% below where we were at the pre-pandemic level of output, and that was from the fourth quarter of 2019. If we assume that we should have been growing at this 2.5% growth rate, we're about 5% below where we would have been without a pandemic. Will we rebound back to this line? Not likely. You kind of look at the consensus expectations, and even though, as Phil pointed out, we're going to get a pretty good number for the fourth quarter, it takes a whole lot to get back up to this trend growth line. And really, if we look at history, is this any different than what we normally expect to see? This kind of shows the last couple of slowdowns and recessions. This one here in the middle is from 2008, the great financial crisis. We didn't really get back to that trend growth number. And then also the tech crash, tech bubble back in 2000. So, what you kind of see with these GDP numbers is that you kind of hit this air pocket, this turbulence, where then you drift lower, but then you kind of continue to reestablish that growth trajectory just from kind of a lower starting point going forward. So it doesn't really, it doesn't change much other than, you would have been better off not having been through a pandemic, but I think we can all agree that we would have rather had that.
Yeah, so the way I think about it is, it's going to leave a mark. We're not going to get back to where we would have been had it not happened. But notice in the prior crises, how there was kind of a gradual recovery. This was very, very different than past events. We had a sudden stoppage of economic activity that really was unprecedented in the magnitude and the speed at which it occurred. And it was critically important that there was kind of a snapback, or the gap would have been much, much more dramatic on a going forward basis. We've gotten that snapback. We've had kind of that V shape from the bottom at least. But, if you look at it, that V isn't going to continue. We're not going to keep going at the rate we have been and get back to trend. It's going to start to level off a little bit. We still expect above trend growth for the next few quarters, but it's not going to be enough to get us back to the trend line. But it is still a much, much more rapid response to this crisis than in the past.
Yeah, and I think that's important to point out, is that we are expecting better than prior growth rates as we recover and as the economy opens back up. So, Phil, do you want to talk about employment?
I'd love to. This is an important element because it's one of the two key factors that the Fed's going to be looking at. And the Fed continues to suggest, hey, we're planning on keeping rates low. We're going to show you a chart in a little bit. By the way, forgive us, we didn't mention this, but if you have questions, feel free to enter them into the chat feature on Zoom at the bottom of the screen. We do have a really, really good question from one of the participants today about debt and continued growth of debt. We're going to show you some data on that in just a few more slides that I hope will answer your question. But the Fed has been forecasting, and we'll show you that graphically as well. We're not thinking we're going to raise rates in 2021, 2022, maybe not until late 2023. And so we can expect a very low pro-growth interest rate environment for the foreseeable future. The two things that are going to sway the Fed from that stance is the recovery in unemployment or higher inflation. And so we talked a little bit about inflation earlier. The Fed is very comfortable running at 2% or a little bit above 2% because we've been below 2 for so long. The expectations are we might see inflation pick up and then drop a little bit. We're probably going to see inflation pick up a little bit near term. Then it might come back down a little bit, and then we'll be in that 2 to 2.5% range. There are not many expectations that we're going to have runaway inflation that hits 4 or 5, 6% or higher. We're really talking about mid 2s to 3s is higher inflation, which is the world that I lived in when I was going to school studying finance, we didn't talk about getting up to 3%. We talked about getting back down to 3%. So the world has definitely changed. The other thing that they're focusing on, though, is unemployment. And what this chart, the left side of this chart shows you is, yeah, we lost a lot of jobs, and we lost them quickly. When companies closed down in response to this global pandemic, they laid people off. And that's one of the reasons that part of the government's original stimulus, the CARES Act, included extended unemployment benefits, because they recognized, hey, look, these businesses are shutting down because of the virus and trying to slow the spread of it. And there are a lot of people who are out of work as a byproduct, and we expect it to be temporary. Well, that's what this chart shows you, is that, half the people who lost their jobs very quickly got them back. It took us a decade to add 23 million jobs, 22.8 million jobs between February of 10 and February of 20. And then we lost them in 2 months, 3 months. And so it was unbelievable, the rate of job loss. But from April till now, we've added back 12 of those 22 that we've lost. And this line, we don't think that this line is going to go back to trend growth just yet. We think there's still opportunities, particularly as we get these vaccinations distributed and have more businesses reopening, have people able to go out to restaurants the way they used to, get people traveling again. Disney laid off, I don't know how many tens of thousands of people. When they're able to open the parks and people want to go to Disney and take their kids to Disney again, they're going to need people working there. And so a lot of these jobs are going to come back, not all of them. And so, we were at 3.5% unemployment before this all started, which is incredible. Some people would argue that was actually below equilibrium. We're going to get back to, I think right now we're at 6.7, 6.8% unemployment. We're going to get back to 4.5 to 5% pretty quickly, but closing that gap is going to take a little bit of time to get those last people who want to work back into the labor force. The right side of this chart, though, shows you the data by industry, and it really does drive home the point that, a lot of these industries have hired back half to 2/3, but still have places to go. So you can just kind of read across the bottom there and see what those industries are. But they're the ones that you'd expect, the ones that are most impacted by shutdowns. They're the ones that, until we get things fully reopened again, but when things are fully reopened again, you would expect to see some pretty good surges in some of these industries. So a lot of optimism for people getting back to work.
Yeah, a lot of upside once the economy opens back up.
So moving on from that gives us an opportunity then to look at corporate profits. And you know what, Ryan, why don't you go ahead and talk about corporate profitability a little bit?
Sure, yeah. So this chart here, it shows the quarterly EPS number. It's earnings per share of the S&P 500 as a whole. So those are the largest 500 companies in the U.S. And you'll see that this is a year-over-year change number. So it's a percentage change or a growth or a decline. You'll see that pretty big decline here in the first quarter of 2020. Earnings went from about $38 a share in the prior year, so that would have been the first quarter of 2019, all the way down to 19.5 in the first quarter of 2020. So 50% drop. That rattled a lot of economists, a lot of on-screen personalities talking about a 50% decline, how we hadn't seen that in a long time. What I wanted to do was just provide some context here. When you looked at the fourth quarter of 2008, so kind of the epicenter of the great financial crisis, we were down 100%, actually a little more than 100% on a year-over-year basis. We printed a total EPS number of -9 versus the year before $15 per share. So huge drop off. Now, obviously, that was those were a lot of write-downs. Companies were way over levered at that point, and so a lot more hemorrhaging back then. So just wanted to provide some context for what we've kind of seen so far in this recession, and then also provide some context for what happens after that is that you typically see a pretty big rebound, and some of that is due to an easy comp effect. And what that means is that, well, if you're comparing it to the year ago numbers, well, you look at, how bad was it 4 quarters before, and then we have we've got a pretty low hurdle to clear. And while, some of that is in this plus 90% number that analysts are looking at, it really, it's not all because of an easy comp number. And, so this chart here looks at the earnings per share numbers on a quarterly basis. Now, if you kind of roll those up into an annual basis, I think this next chart really kind of shows what's happened here. 2020 is this first green bar here. So yeah, we were down from prior year levels, and 2021, the year that we're currently in, analysts are expecting us to actually be higher than the total earnings per share that we generated, that corporations generated in 2019. So it's really not just a rebound effect or an easy comp effect. This is a legitimate recovery, and putting people back to work, and companies coming back actually stronger. At least the largest 500 companies in the U.S. Coming back a lot stronger than the shape that they were in entering 2020. So we're encouraged when we look at corporate profitability. It's one of the kind of one of the big factors that goes into employment, right? Your companies have to be financially sound. They have to be on a good footing in order to want to hire additional employees. And following the great financial crisis, they were not in great shape, and so that recovery took a lot longer. This is encouraging to see that maybe this one will be a more powerful recovery than the last, speaking to Phil's point earlier about faster economic growth.
And it's not just expected to be in 2021, but if you look at that far right bar, I mean, there's another meaningful increase in earnings expected in 2022. So, we're looking at, again, we're in the early stages of a recovery when you go back to that business cycle, and this is what happens in those phases. So, again, very, very encouraged and optimistic. I would be remiss if during this presentation I didn't say we're sharing everything we can about what we know today. You don't know what you don't know. And so there are going to be surprises, either positive or negative, and that we can't really predict. We don't know where those will come from. But the world that we're living in today, with all of its blemishes and imperfections, the outlook for companies able to execute on strategy, deliver earnings per share, which results in growing stock prices, looks pretty good at this point.
Yeah, agree. I mean, yeah, we're diving deep into the numbers on some of the most important things that affect the fundamental trajectory of the U.S. economy, and as well as the stock market, because that's where a lot of people are invested. So let's take a look at debt. It's a big concern, one of the biggest concerns on a lot of people's minds, especially following kind of the nearly unprecedented stimulus we've already seen. I say nearly because it is the largest stimulus we've ever seen from the Federal Reserve, but as Phil shared earlier, fiscal response to World War II was actually greater. Now, if we get another $1.9 trillion stimulus plan out of the government, then, well, we'll update that chart and we'll share it later. So here is, this is federal net debt. As Phil mentioned, we had a question come in about government debt and when it reaches $30 trillion. So important to also keep in mind that gross debt is different than net debt. We owe some of that money that we owe ourselves, and so it's taking money out of one pocket and putting it in the other. And so once you kind of net out all of that, this chart here shows what most economists are what they look at, and that's the condition, that's the state of our current federal net debt. And so we're we exited 2020 with about 100% when you compare our net debt to the size of our economy. That's how a lot of economists prefer to look at it, because it's not the absolute number of the absolute value of the national debt. Obviously, 20 plus trillion dollars in gross debt is huge. It's high. It's higher than it's ever been. But if you look back in history, our economy wasn't nearly as big as it was back then. So you have to normalize it for the growing size of the economy. Obviously, a bigger economy can handle more debt, and so that's what this chart does. Is it kind of normalizes it for the size of our economy, and then it shows us as a percentage of the size of the economy, how much is that debt? Well, we're at 100% right now. About a year ago, we were at about 80%, which was it was alarming. And, it looked like we were headed up and right. And so obviously that has people concerned. Well, we kind of pulled a lot of that forward, and we're already at 100%. So that, obviously has a lot of people concerned, and rightly so. But what we want to do here is kind of share some context on how this level of debt for the United States compares to other major world economies. And so on this next chart here, what I've done is pulled data from the IMF on government net debt as a percent of those economies' GDPs. And so we've got a good illustration here of where the US fits. We're here in the kind of red purplish bar with all the other economies. And you can see that, Japan has the highest percentage of debt as a percent of their gross domestic product, nearly 200%. Italy, right after that, Portugal, France, Spain. Just on the other side of us is Belgium, the UK. So these are all developed economies. They do a fine job of servicing their debt. They can make their interest payments. You'll see some emerging market countries in here. Those would be a little more troublesome if you're an emerging market country and you're very dependent on raw materials and producing raw materials to sell to other economies. That's a more precarious position to be in if you've got a high amount of debt. We've got a really well-diversified U.S. economy, one of the most diversified, really, when you look at what our economy looks like versus others. And so we're in decent shape. We're ranked 6th on this spectrum here of net debt as a percent of GDP. But next couple of slides, I'm going to take you through how this chart changed over time, because this chart didn't look like this last year. The IMF was expecting us to end 2020 with less than 100% net debt. Whoops, I went backwards. So down here, the bottom bars, the darker blue and the darker red purplish bars, are what the International Monetary Fund had predicted that we would end the year 2020 with. And then the lighter shaded bars up on top are what we actually added to our net debt. So the pandemic created a situation where there was a lot of fiscal response. Everybody wanted to bridge the gap between, everybody shutting down the economy and having to stay home. Well, we can't have people starve, and so we've got to send out some assistance. And so that fiscal stimulus got tacked on. So really those light blue bars at the top represent incremental stimulus that each of these countries engaged in over the past year. What's interesting here is that because a lot of people focus on just the numbers, the absolute numbers of the stimulus that the United States threw at the problem. But if you look across the board here, all of the countries did the same thing. This kind of speaks to the question of eroding value of the US dollar relative to other currencies. Well, currencies are only valued relative to each other. So if everybody is issuing more debt, then the currencies kind of stabilize against each other. What would impact the US dollar negatively would be if the US threw a couple $1 trillion at the problem and nobody else did. Then that would pretty significantly erode the value of the US dollar. But you see here that those light shaded boxes, that everybody really, contributed stimulus to it. The next slide is going to take those light shaded boxes, and it's going to array them from who provided the most stimulus to who provided the least stimulus out of these countries. And again, the United States still not at the far right. So as a percentage of our GDP, these are percentage points of GDP, we increased our net debt as a percentage of our GDP by 22.9 percentage points, not as much as Italy, Spain, Japan, pretty much on par with the UK. Even Canada at 20.7 percentage points of their GDP. So again, I share this so that you have some context for, these were large absolute numbers of stimulus. Everybody played the same game, and everybody is just trying to bridge what was a global pandemic, the unknowns, as Phil referred to earlier, what we couldn't see coming at us, because this was not your garden variety recession. This was not, everybody's taken on too much debt and now we can't service that debt. This was a medical emergency that came out of left field. And so the governments across the world stepped in and said, we're going to figure out, we're going to throw money at it. We're going to bridge the gap between the crisis and the recovery.
Hey, Ryan, we have a question here from a participant asking, do you know about how much debt China has or how they would fit into this? I don't know if you've seen that data recently.
I'll have to follow up on that. There are different measures for Chinese debt. It gets messy because some of the Chinese debt is, if you're just looking at government debt, you should probably add in some of the corporate debt too, because those are state-owned enterprises. And so it gets really muddy on, what do you exclude, what do you include? And then there's, their banking sector, is also some state-owned enterprises. So I'm not sure, but I can get those that data sent out to people afterwards. So let's see. Now this is really what's most immediately relevant to the conversation on the state of U.S. government finances is kind of the level to which we can service our debt, which really means whether we can make our interest payment. Now you look at this top chart. Since 2007, our net interest outlays have generally remained pretty relative, and they've actually come down since the late 90s relative to GDP. Right now, it's about 1.6% of our GDP goes to, as the size of our economy is spent servicing our debt. Now, as a percentage of government spending, it's about 6%. But this gives you good historical context. This top chart gives you good historical context on where that has been. Now, that is despite, as this middle chart shows, the rapid growth in debt that we've issued, right? We're at about 100% of GDP in government debt. So how is it that our servicing costs have remained low despite the large amount of debt that we've issued? And that's explained by the third chart, which is really the biggest component to our net interest outlay, which is, well, what is the interest rate that we're paying on our debt? And that's because we've had 10-year treasuries and even shorter duration bills, which is what a lot of our debt is issued in, have been low for a long time and have been trending lower. Some people get nervous because they say, yeah, but what about what's going to happen when interest rates move up? We're going to refinance our debt at higher interest rates. Well, you look at, here's where the federal funds rate is. It's at essentially zero. The Fed doesn't expect for that to jump anytime in the next 2 or 3 years. This chart also shows the market expectations. That's kind of the brown line and the brown numbers there. So even the market doesn't expect the Fed to raise interest rates anytime soon. What would cause the Fed to raise interest rates? If the recovery starts to overheat, that's always one reason. We got back to, we started raising interest rates in kind of late 15, early 2016, And it wasn't that we were overheating, but it was just that the Fed, they wanted to kind of reload here. They wanted to have some ammo for the next time that we got into a recession so that they could lower rates and stimulate spending in the economy. You know, the other reason that the Fed might raise interest rates might be inflation. And Phil, you kind of talked about that earlier. Yeah, when we look at some of the manufacturing data that's coming out across the world, you are seeing a little bit of inflation. Now, these are raw input type inflation or you know, kind of early production inputs. You see a lot of reports coming out that they can't get enough raw materials. They can't get enough early stage products so that they can assemble it into a final stage product and ship it. So they're paying a little bit higher price right now. I don't think that that's persistent, that's going to be persistent. I think that that's a short-term inventory restocking and logistics phenomenon. If you think about what's the biggest impact to inflation over the long term, I think what's really kept inflation low for so long, really since the 70s, we've seen inflation come down from about 15% down to where it is now. You know, I mean, for a while there, it was, near zero, even negative a couple of months. But now we're back up to about 1.6 or so percent inflation. We might see that tick higher, as you mentioned. But again, the long-term impacts to inflation, the things that really keep a lid on inflation that were not around in the 1970s and in the 60s and the 40s, you've got the internet, which it has really, really squashed a lot of the price increases for industries and sectors, across the spectrum. I mean, you can see how easy it is to price compare now these days versus, pre-internet. You'd have to go to Walmart, you'd have to go to Target, you'd look up your local newspaper to see, who's selling turkey at the cheapest price per pound. But you didn't have the visibility and you couldn't price compare the way that you can now. So competition has increased dramatically over the past 20 years since the advent of the internet. The other thing that wasn't available before is globalization. Before China opened up to the World Trade Organization, which was really they were admitted in the early 2000s. Before that, you manufactured everything in your own country, or for the most part, you manufactured most of what you sold to your own country within your borders. Maybe an adjacent neighbor would produce for you, but if you wanted cheaper labor, you didn't have a whole lot of options to choose from. But globalization really allowed that boom to happen. That's how we shipped a lot of manufacturing over to China. Now that China's labor rates are going up, we're actually, and some of this trade spat with China has actually been good for the United States because we've seen how easy it is to shift our supply chains to a different country. So we can go to Vietnam, and if we don't like their pricing, we can go to Indonesia, and India is another big exporter of cheap labor. So I don't know that we're going to see prolonged inflation. We might see little, flashes of it here and there, but for the most part, I don't think that we're going to see a lot of prolonged inflation.
And the other thing that's going to help keep inflation low, we've heard some people argue that technological innovation has driven efficiency in a level that also creates a bit of a headwind to rising prices. So you could see a more moderate rate of inflation because of that as well. All of this goes into the answer to the question: if there isn't inflationary pressures, the Fed probably isn't going to raise rates too far too fast. And if the Fed doesn't raise rates too far too fast, the percentage of GDP that's being devoted to our debt service is likely to remain low and at a very manageable level, even with these higher debt loads. That may not always be the case, but certainly near term, next 3 to 5 years, seems that it'll continue to be manageable.
Yeah.
So we're rounding the bend here. We just wanted to share a little bit about the consumer and then conclude for you. We do recognize it's right now at 12, so forgive us for going a little bit long today. But the point here I kind of alluded to at the beginning of the presentation. Household debt is very low as a percentage of their disposable personal income. And so what that means is the consumer is in a very good position. They've been saving more than they normally do. And in aggregate, the American consumer is ready to get back out there to spend some money and maybe even borrow at some pretty attractive rates. And that is awful strong fuel for the U.S. economy, keeping in mind that the U.S. consumer is 70% of GDP. This is something to keep an eye on. And this chart just shows you, we're looking at the last 4 decades, we haven't had a debt payment as a percent of GDP as low as what it is. Part of that's because of the low interest rates. People have been able to lock in lower rates on their mortgages and whatnot. But there's just an awful lot of dry powder there to help fuel this economy. And so, in summary, what are the positives? What are the negatives? What are we looking at that we think could be good versus a concern? As we've talked about, the monetary stimulus from the Fed, not just in terms of interest rates, but in terms of their participation in the bond market, buying bonds, that's going to be stimulative. The fiscal spending and the follow-on that could come from that, particularly with this administration, looks like that'll be stimulative. I personally am a little bit frustrated that there haven't been more vaccinations yet, but I do expect that engine to start really, turning over at a more rapid rate. We're going to get more vaccinations approved and more distributed, and ultimately more into, the arms of Americans, which will allow the economy to reopen. Politics aside, whether you like the outcome or dislike the outcome, it's over, and we can at least celebrate that the uncertainty created by an election is no longer impacting the markets. This fiscal Goldilocks scenario, which is not too hot, not too cold, but it looks like there's going to be some good things there in terms of maybe some additional stimulus to the economy through spending, but maybe not some of the weight that could have been put on the economy through some different tax policies. And that's not to say that taxes aren't going to go up. President-elect Biden does definitely have some tax policy thoughts in mind, higher income tax rates for some Americans, perhaps a change to the capital gains tax rate, perhaps higher corporate tax rates, perhaps different estate tax treatment. All of those things are on the table. And I'm not trying to suggest that none of that will pass. But right now, with the economy being where it is, most of those things, if they are to pass, a lot of people think they could be later 21 or even 2022 kind of timeframes. It's hard to pass a lot of tax increase when the economy is still struggling. But some of the targeted tax increases absolutely could. That's something we're going to be watching very closely, and there may be some specific recommendations for each of you individually that we'll be sharing with you in light of that. As I just said, the U.S. consumer is in great shape, and the financial conditions index, which just kind of measures, how are things looking. We have record easy conditions, which would suggest that we're ready for this economy to grow above trend. And, Ryan summarized it here as liquidity, liquidity, liquidity. There's just a ton of cash out there. It will be really interesting to see the impact that has as we move forward. There are some concerns, and we're not looking at this through rose-colored glasses. This slower than expected vaccination rate is something to keep an eye on, and a lot of the optimism is predicated on the economy reopening. And if we can't get people who want the vaccine vaccinated, then the economy won't reopen on the same pace. Even if it takes longer, though, the market's looking at the eventual reopening, whether it's in third quarter or second quarter. That's not going to derail things too much, but it could shift some of the growth from 2021 into 2022 if it's delayed too much. We also have to be concerned about the more rapid spread of the virus due to some of the strain mutation that's happening. So, we'll be watching that. Again, I think that increases the urgency with which we need to get some of these vaccinations out there. If inflation did rise and stay persistently higher, that's something that could be a negative, definitely worth keeping an eye on. Again, we're not real worried about that. And then, of course, anytime there's political disruption, Ryan and I had a conversation about when we should have this. We wanted to get past the end of the year and into 2021, and have an opportunity to kind of digest some of the other opinions out there, so we could give you kind of the summary overview. And we thought once we got past the Georgia Senate elections that the political disruption would be behind us. And then we had, the protests at the Capitol, and there are concerns about what might happen on Inauguration Day. So continued political disruption could be a negative, one that absolutely merits keeping an eye on that. We got a question that said, gosh, you guys sound like you're pretty positive on the stock market, and we are. And we're not alone in that. What we're sharing with you is the consensus view. The question was, okay, so if this is what we're looking at, we got, year-end value for the S&P 500 was just under 3750, and the consensus estimate is we might have a 12% return in the S&P 500 in 2021, rising to 4250. But there's a range around those estimates, as there always is, ranging from 4,000 to 4,500. That's where we come at it and say, look, it could be another pretty good year for the S&P 500. And those would be large companies, to the point Ryan made when he looked at the different time periods for 2020. Small cap stocks might even do better than the large cap stocks, and so that's really interesting to keep an eye on. Talking about the 10-year Treasury, the estimate is that we'll see those yields moving up to 1.3. Well, heck, they've already jumped from 0.93 to, I think, 1.13 is what I saw it yesterday. I'm not sure exactly where it is, since we've been on this call, but half of the gap between where we ended the year and where they thought we'd end the year has already been covered. The range is a wide range, anywhere from 1 to 1.75. But here's the caveat: forecasts aren't worth the paper they're written on. If you looked at the forecast for the 10-year Treasury at the end of 2019, everybody was wrong. Nobody, literally none of the experts said, oh yeah, we're going to drop to below 1. And so, take it with a grain of salt, but these forecasts are coming from, it's summarized there at the bottom for you. We looked at some data from CNBC and the Wall Street Journal, but also, we looked at JP Morgan, Goldman Sachs, Fidelity, First Trust. And we threw our own little mix into this. A lot of what you've heard today is data and facts. Some of what you heard today are opinions. And so Ryan and I are happy to share what we're thinking, because a lot of you kind of want to hear, what are you guys thinking about this? Where do you think we're headed? We admit we can be as wrong as all these other experts. We're not saying this will happen and therefore let's take this action. And so I had a really, really good question come in from one of you asking, given that you're as optimistic as you are about the stock market, are you going to do anything with the portfolio structures as a byproduct of that? And the answer is we're going to encourage you, but no, we're not going to be making wholesale asset allocation changes, shifting from bonds to stocks to try to capitalize on more strength in 2021, because we could be wrong. There could be something unexpected. I made the comment earlier that we don't know what we don't know. If something unexpected happens and this market takes a downturn, even though the yields and the expected returns on bonds are fairly modest right now, they're going to hold up better than the stocks will if we get bad news. Now, again, we think the risk to our forecast right now, my opinion, there's more risk that it exceeds the forecast than there is that it underperforms the forecast. I really do think there are a lot of things pointing in the right direction right now, and there's been a lot of pessimism that as that pessimism shifts to more optimism, you can really have some fuel. The amount of dollars sitting on the sidelines right now, Ryan had some data that he shared with me about the amount of cash sitting on the sidelines. It's unbelievable.
Yeah, let me just read that off. I got my paper right here. In personal savings, back in March of 2020, personal savings were $1.2 trillion. Over the next 9 months, that doubled to $2.6 trillion. The S&P 500 companies have raised or have accumulated $2 trillion in cash over that time frame. Money center banks have over $3 trillion in reserves for defaults that did not happen during this crisis that they can now put to work. So that's a total of $6 trillion in extra assets that could be deployed over the second half of this year or next year. And I talked to a guy at Fidelity who said, we have $4 trillion sitting in money market accounts, just in money market funds. If the stock market begins to, if it starts to take off, that's when you see a lot of that money market, a lot of that cash come into the stock market, and it further perpetuates that upside.
So, you know, we have a lot of fun with this, right? Do we have another slide, Ryan? Is it just the conclusion? Yeah. Oh, yeah. So this is a busy slide. You don't pay too much attention to it, but this quote from Heraclitus is one that gets retread over and over in different versions. That is the only constant is change. And so 2021 will look different than 2020, and 2022 will look different than 2021. And we don't have a crystal ball that we can tell you what's what. What this chart shows you, though, is the different colors represent different building blocks that we use to make up a portfolio. And if you look at the top or you look at the bottom, you'll see some of the things that are at the top immediately go straight to the bottom. Some of the things that are at the bottom go straight to the top. And some of the things are bouncing around in the middle. That's the reality of investing, is that, you know, we know things move around. Whatever was best in 2020 might not be in 2021. Whatever is best in 2021 probably won't be in 2022. Sometimes you get a multi-year run where something does well, like real estate did really well in 2010, 11, and 12, but that was in part because it was a disaster in 2008 during the financial crisis when real estate lost 37% of its value. So, you know, you got to look at the big picture, but our point is we still strongly encourage our clients to be diversified. It's impossible to know in advance exactly what's going to happen. So have a strategy that makes sense and a structure that fits what you're trying to achieve, which is our job, to help you determine that and to have the right structure, and then apply it with discipline. And if something goes from the worst to the best and you bought it when it's the worst, you're going to be pretty happy when it happens to be the best. And if you take some of your profits when something's doing extremely well, it won't make you quite as upset when it does really poorly the next year. And I still maintain that discipline of buying and selling with discipline is going to actually augment the returns. You don't just sit on the sidelines. You don't just set it and forget it. There's an active level of involvement, and that's what we try to do for each of you. So again, we went a little bit long here. We do appreciate your engagement today. We hope that your new year has gotten off to a good start, and hopefully our forecast for you today, one of optimism and a positive outlook, hopefully that's exactly what comes to fruition, and we can celebrate a very prosperous 2021 when we get to the end. So thank you again, everybody.
Thanks for sticking with us. And for any questions that we're not answered on the call, we'll get you offline.
Yeah. Take care.